Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Welcome back to the Ask Ralph Show. You know, a lot of times in our practice, we'll get asked, what would cause me to get audited? And I did some research and I found an article that ran on the Money website back on Sunday, April 9, 2017. It was written by a person named Ramona Padden. And what they talk about here is 7 reasons the IRS might audit you. Now, one of the things I will tell you is it's been my experience that the number of audits has certainly gone down. That being said, I think they're doing a lot more targeted audits, taking a look at specific items to go after an audit. But I thought these were very good topics to talk about today, so I thought I might endeavor to talk about these 7 reasons the IRS might audit you. Now, the first one is making math errors. Now, this one, in my opinion, can really be resolved by using good software. And this applies to everybody who files a return. You really need to pay attention if you're going to do the return yourself. Make sure you don't either key in information incorrectly, or if you're actually doing it the old pen and paper way or pencil and paper way, you may want to make sure to double and triple check your numbers. Here's the issue, because if you make a mathematical error like that, they're gonna hit you with a penalty for making a mistake, regardless of whether it was intentional or not. And that's why this article, and I have to agree, recommends using a tax preparer or a tax preparation software, because a lot of those things have, math built into them. Now, the second thing is failing to report some income. Now, this is a very easy way to get audited. And what I'm talking about here is if you don't report all of your income. I remember a few years back when I was working, I had somebody come in and I got their tax return all completed. And then they said, "Hey, Ralph, I got a question for you. Now, I got this other W-2, but the employer spelled my name wrong. Do I still have to claim this?" I thought it was kind of funny. But anyway, so I said, absolutely. If you've got a W-2 that was filed under your Social Security number, and we checked and it was, then you want to make sure that you record that as income. Now, the W-2s are usually pretty self-explanatory, but how about 1099s for any miscellaneous income that you may have earned? That's something the IRS is going to take a look at and match. And I've mentioned this before, and other times I've talked about this. The IRS gets a record of all of these income streams, and what they do is they compare that to the income that you report. Now, you might not consider this an audit, but it is in fact an audit where you'll get a letter that says, "Hey, Mr. Jones, we reviewed your tax return and we noticed that you didn't report something." So it's very important that you pull all these things together. Now, not just income from jobs, but income from any banks or credit unions you might have, if you sold any stock. All these things are going to be reported to the IRS. So it's very important that you record those as well. Next one, number 3, is claiming too many charitable donations. And I'll tell you what, I just had a client recently to this affected. And you really need to make sure that you've got yourself documented on these charitable contributions. It's a bit of common sense, but don't report false donations. And if you do report those, you need to make sure that you follow the rules. Now, one of the rules I talked about, and I think it was last week on the show, was if you had charitable contributions in excess of $5,000, you actually need to go and have an appraisal done by an independent appraiser. Now, that being said, another rule of thought, frankly, is to take a look at the percentage of charitable contributions to the amount of income that you show. I remember a few years back, I was doing a tax return for a lady who had quit her job and she actually started a church in her home. And when she came in, she said, "Listen, I only made about $10,000 this year, but I donated $50,000 to the church." And, I kind of looked at her and said, wait a second, well, that doesn't make a lot of sense. How could you have donated $40,000 or $50,000 if you only made 10? Well, of course, she explained it to me that this was money she had inherited and this was just, came out of her savings. Now, of course, there's limitations to how much of that you can take per year, but those are the kind of things that are going to jump out in audits. They're going to take a look at that and say, wait a second, how are you making this much in charitable contributions? Now, number 4, and this one I find a lot of times happens, and that's reporting too many losses on a Schedule C. Now, for those of you who aren't accounting or tax nerds like me, a Schedule C is where you report self-employed income. So let's say, for example, you sell I don't know, Tupperware. I don't know if a lot of that goes on anymore, but let's say you sell Tupperware and you have these parties and you sell this Tupperware. And then what happens now a lot of times is, the person that you sell this Tupperware for, like Tupperware company, will send you a 1099 at the end of the year. And they'll say, hey, you got to report this income. Now, a lot of times the goal will be to, let's see how many expenses we can offset against this. And I will tell you in my practice, I'm very cautious about this, because what happens is if the IRS deems that this is not really a job or a business, but more like a hobby, then they can actually disallow these losses. And I've taken over clients who have had loss after loss after loss on their tax return. Now, the general rule of thumb is to make a profit 2 out of 5 years. But I think you really need to take a look at this, because this is a way to most definitely get yourself audited, especially if you have outrageous deductions. I had a client a few years back that had done that, and they were taking a $20,000 loss on their tax return every year. Now, they had other income to offset that, but it just didn't look right. Next one, number 5, claiming too many business expenses. This goes along the same lines as, claiming big losses. And that is, to be eligible for deduction, the purchases must be, number 1, ordinary, and number 2, necessary to your line of work. For example, they note in this article, a professional artist could claim paint and paintbrushes because such items meet both requirements. A lawyer who paints for fun and doesn't turn a profit on the works couldn't claim the art as a deduction. One of the things that I always say is, if you can convince your grandmother that it's a legitimate deduction, then it probably is. And the question they ask here is, was the purchase absolutely necessary to perform my work duties? So another good point. Number 6, claiming a home office deductions. Now, I think this is one of the biggest areas for fraud. And it's tempting because, you may have a small side business or something like that, and you say, well, I do all my work at home. Now, what you need to know is the IRS narrowly defines the home office deduction as reserved for people who use part of their home exclusively and regularly for your trade or business. So what this means is that a home office can qualify if you use it for work and work only. Now, in practice, what I hear people say is, I use the spare bedroom for that. I said, okay, so that when you have guests over, where do they sleep? Well, they sleep in the spare bedroom. Well, that by its very nature will fail that test. So if you're going to take a home office deduction, make sure that it is precisely, exclusively and regularly used for business. The final one here, and I think this one's kind of funny, and that is using nice, neat, round numbers. And they say here in this article, in all likelihood, the numbers in your 1040 and supporting documents will not be simple, clean intervals of $100. So when making your calculations, be precise, and if some of this isn't intended, I've had clients that say, I spent about $300 on toner this year. Oh, my insurance was around $200. Oh, this, that, and the other thing. Now, the key is that you need to be specific in making sure that you have your ducks in a row and that you're actually claiming the expenses based on the actual expense receipts. And those aren't usually tidy up to the perfect rounding number. So again, I think these are really effective things to take a look at, and they may prevent you from getting audited. So, and the best rule of thumb is just be reasonable. Make sure that the things make sense. Make sure you're claiming all of your income. Make sure that you can document your expenses. Make sure that you're not continually running losses. Well, I hope this was helpful.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.